The Beanie Baby Bubble: How a Plush Toy Craze Turned into a Speculative Mania.
If you found this story insightful and want more deep dives into real financial events that shaped the world, make sure to like the video and subscribe to the channel. Your support helps bring more powerful, well-researched stories that break down complex financial concepts into engaging and easy-to-understand content. Stay ahead, stay informed, and don't miss the next story that could change the way you see money.
In the mid-1990s, a small, understuffed plush toy quietly entered the American market. It was soft, simple, and filled with plastic pellets instead of traditional stuffing. Few could have predicted that these toys, called Beanie Babies, would ignite one of the most unusual speculative bubbles in modern financial history. At the center of this phenomenon was Ty Inc., a company founded by entrepreneur Ty Warner. Unlike traditional toy manufacturers, Warner employed a strategy that blended scarcity, clever marketing, and psychological triggers. Each Beanie Baby came with a unique name, birthday, and a short poem printed on its tag, giving it personality and emotional value far beyond its material cost. Initially, Beanie Babies were sold in small gift shops rather than large retail chains. This limited distribution created an early sense of exclusivity. But what truly fueled demand was the company's deliberate control of supply. Certain designs were retired without warning, meaning they would never be produced again. This artificial scarcity transformed ordinary toys into perceived collectibles. As word spread, demand surged. Parents, children, and collectors began hunting for specific Beanie Babies, often traveling long distances to find them. What started as a niche collectible quickly evolved into a nationwide obsession. By the late 1990s, the secondary market exploded. Beanie Babies were no longer just toys, they were assets. People began buying them not for enjoyment, but for profit. Online platforms like eBay became central hubs where prices soared to astonishing levels. A Beanie Baby originally purchased for $5 could sell for hundreds or even thousands of dollars. This rapid price appreciation created a powerful feedback loop. Rising prices attracted more buyers, and more buyers drove prices even higher. It was a textbook example of speculative behavior. People began to believe that Beanie Babies were a reliable investment, with some even comparing them to stocks or real estate. Entire strategies emerged around Beanie Baby investing. Collectors preserved tags in pristine condition, stored toys in protective cases, and tracked price guides that listed estimated market values. Some individuals went further, purchasing large inventories with the expectation of future gains. In extreme cases, people took on debt or diverted savings into Beanie Baby collections. The media played a significant role in amplifying the craze. Stories of rare Beanie Babies selling for thousands of dollars created a sense of urgency and fear of missing out. The narrative was compelling. Anyone could turn a small purchase into a fortune. This democratized fantasy of wealth fueled participation across all demographics. However, beneath the surface, the fundamentals of the market were fragile. Unlike traditional investments, Beanie Babies did not generate income, nor did they have intrinsic value beyond what buyers were willing to pay. Their worth depended entirely on continued demand and the belief that prices would keep rising. This is where the bubble dynamics became evident. Speculative markets often rely on the greater fool theory, the idea that one can profit by selling an overvalued asset to someone else at a higher price. As long as new buyers enter the market, prices can continue to rise, but once demand slows, the entire structure becomes unstable. By the turn of the millennium, cracks began to appear. The market became saturated. More people were trying to sell than buy, and prices started to stagnate. At the same time, Ty Inc. increased production of certain toys, undermining the perception of scarcity that had driven much of the demand. As confidence waned, prices began to fall. What had once been considered rare and valuable quickly lost its appeal. Listings that once attracted bidding wars now went unsold. Collectors who had invested heavily found themselves holding assets worth a fraction of their purchase price. The collapse was swift and unforgiving. Many individuals who had treated Beanie Babies as investments suffered financial losses. Collections that were once valued in the thousands became nearly worthless overnight. The market that had thrived on hype and speculation could not sustain itself once the narrative shifted. The Beanie Baby bubble offers several important lessons about financial behavior and market psychology. First, it highlights the power of scarcity, real or perceived, in driving demand. When supply is limited, people are often willing to pay a premium, especially if they believe the item will become more valuable over time. Second, it demonstrates how emotional factors can influence financial decisions. Beanie Babies were not just investments, they were tied to nostalgia, identity, and the thrill of collecting. This emotional connection made it easier for people to justify increasingly irrational prices. Third, the bubble underscores the risks of speculative investing. When asset prices are driven primarily by hype rather than underlying value, they become highly vulnerable to sudden corrections. Without intrinsic value or income generation, such assets rely entirely on market sentiment. Finally, the story reveals the role of social dynamics in financial markets. The widespread belief in Beanie Babies as a profitable investment created a self-reinforcing cycle. People were influenced by friends, media, and the visible success of others, leading to herd behavior that amplified the bubble. In retrospect, the Beanie Baby craze may seem like an anomaly, but its underlying dynamics are not unique. Similar patterns have appeared in various markets, from dot-com stocks to cryptocurrencies and digital collectibles. Each time, the specifics differ, but the core elements, scarcity, hype, speculation, and eventual collapse, remain consistent. Today, Beanie Babies serve as a reminder of how easily markets can be driven by perception rather than reality. What began as a simple children's toy became a financial phenomenon, illustrating both the opportunities and dangers of speculative mania. The story is not just about plush toys, it is about human behavior. It is about the desire for quick wealth, the influence of collective belief, and the risks of ignoring fundamental value. In the end, the Beanie Baby bubble stands as a cautionary tale, one that continues to resonate in every new wave of speculative enthusiasm.